Barry Norris joins us, CEO of Argonaut Capital. Barry, we've heard a lot from these congressional hearings, but if we just think back over the events from the last couple of weeks, there were concerns about the capital raising at SVB that went badly wrong. And then, of course, the rollback of regulation that saw this bank not supervised, but concerns too about the flight of deposits, a new feature of this particular banking crisis that we've witnessed, how quickly those deposits can move from one bank account to another thanks to digital means. Just weigh in on where we sit in terms of whether the problems around SVB are just a one-off here or really something that dominates the banking sector now.
Well, there's certainly not a one-off. I think I don't think I've ever watched a congressional hearing where there hasn't been a high degree of grandstanding and clairvoyancy. But what we've heard doesn't really get to the nub of the problem, which is that banks have been encouraged by regulation to invest in low credit risk liquid assets, which is actually what got Silicon Valley and in fact Signature, though Signature had other problems as well, into trouble. And essentially this was a bank with a cash flow problem. There are two ways in which banks can go bust, liquidity and solvency. And Silicon Valley was solvent, but it lacked liquidity to meet customer withdrawals, and that is what caused its demise.
Make you wonder whether if this bank were properly supervised, whether those liquidity issues would have been uncovered. If we think about the rollback of Dodd-Frank rules that effectively saw slippage from the threshold of 250 billion to 50 billion in assets, this meant that the bank wasn't subject to the same level of oversight. Do you think it would have uncovered some of these issues if it had had regulators looking at the bank more closely?
No, I don't. And I think there's a high degree of political opportunism with those allegations. I think that regulators were actually encouraging banks to use excess liquidity to invest in securities portfolios. And what we saw at the time of COVID was this tremendous credit and deposit creation from this incredible stimulus. And banks, given that they couldn't lend it out, were effectively encouraged to invest in securities portfolios. And I think Silicon Valley Bank actually had a fairly normal degree of duration risk in its securities portfolio. The problem is that it had a cash flow problem in terms of lack of maturing assets to reinvest at higher interest rates, and lack of new deposits to also reinvest at higher interest rates. And that meant that it couldn't fund its current securities portfolio and therefore had to sell assets which realized losses. It wouldn't have made losses if it could hold those to maturity. But it also, crucially, didn't have enough cash to meet depositor flight when depositors got wind of the other issues of the bank.
So Barry, you've got the opportunity to short banks in the absolute return fund, or in the European Alpha Fund. You've got an opportunity to play in the European banking space as well. What is your positioning around banks at the moment? Are you long? Are you short? Are you even interested?
Yeah, we've had a pretty good month being short free of the banks that have failed, and I still see more bank failures. However, I think the banks that now go bust probably go bust because of solvency rather than liquidity. So if you think about what the Fed has done in meeting the liquidity challenge, the new bank term funding program is more generous than the discount window in that it allows banks to repo, essentially pawning their assets to the Fed at par value rather than market value. And as we saw with Silicon Valley, that means that it doesn't matter if they're loss making on mark to market, because they can get back cash in terms of what they paid for them. So actually, I think that's tremendous help in terms of liquidity. It's actually perhaps too much of a help in that it allows banks to actually receive more cash than what these assets are worth. But I don't think any bank should now be going bust because of liquidity. However, there's a different problem. And the problem is that the Fed funds rate is 5%, and the average interest rate that banks are paying for the deposits is currently just 1.3% in the US. There are around 19 trillion of deposits. So if you were to reprice those deposits, banks, instead of paying about $250 billion a year, will be paying $1 trillion a year in deposit costs, and that will wipe out whole of the net interest income for the US banking sector. So eventually, those deposits will reprice closer to the Fed funds rate, because that's what money market funds are able to pay. And if they're not able to therefore reprice their assets because they're locked up in long duration assets, or they're more illiquid in loan portfolios, then that wipes out net interest income. So instead of going bust for liquidity issues, banks start going bust for solvency issues, and I think that will be the problem going forward.
We've talked a lot about the hunt and destroy nature of markets around this banking story. You point out, obviously, the fundamental structural challenge here going forward that's been generated by the shift in interest rate expectations. Can I ask you about something else that I know a lot of analysts are pointing to? And they're arguing that the nature of the speed of withdrawals has changed as well as we've moved into the Twitter era. Is there something in this, and do you think the regulators may begin to think about how they can slow capital flight from banks? I mean, obviously, just talking about it may encourage some people to move their money, but is there something in this that in the old days, if you had to queue up at the cash point, that in a sense was a frictional reduction in the pace of flight? These days, if you can just do it on your mobile phone, you can actually empty out a bank in pretty quick order.
I think that reducing the risk of deposit flight through trying to lock in depositors to banks or control social media, or even introduce a wider insurance program to insure all deposits is a waste of time, and it will cause more problems going forward. Because if there is no market element in deposit risk, then essentially a bank that is set up to use deposits to speculate in crypto would essentially have the same credit risk on deposits as a bank that has been going for 100 years, helping local communities, helping people buy their homes. And that is a high degree of moral hazard. And in fact, that will bring more instability to the banking sector than the current regime, where there is some onus on depositors to think about the risks they're taking when they deposit money at a specific bank. So, to my mind, I think the authorities in the US have come out and said, don't worry about your deposits. We've got your back. But I think the implication in that is we're not going to do anything about deposits until after the bank has gone bust, and therefore still have an element of the market being able to differentiate between banks in terms of some credit risk to depositors.
Barry, always good to catch up with you. Thanks so much for giving us your time. Barry Norris, the CEO of